Thanks for joining today. So, of course, I was fortunate enough for Sonia to give me the morning slot to talk about cryptocurrency and tax. Of course, I'm going to bug up your Friday morning as well, just by explaining to you some of the various tax implications and giving you the inside scoop in relation to the various elements from a tax point of view relating to blockchain-based digital assets. So, let me just try and... Okay. So, for those of you that don't know me, my name is Wiehann Olivier. I am a partner at Forvis Mazars and also the FinTech and digital asset lead for Forvis Mazars in South Africa. So I'm also a chartered accountant, registered auditor, JSE accredited auditor. Also hold a master's in blockchain and digital currency and currently a PhD candidate on development of a framework for auditors to effectively gain assurance over blockchain-based digital assets. So for those of you that are familiar with the brand Mazars, of course you see a new name there, Forvis Mazars. So from the 1st of June, we entered into a new network of firms creating Forvis Mazars, effectively pushing us up into a top 10 audit tax and advisory firm globally. So we service a variety of clients, various industries, including that of the cryptocurrency space. And of course, we provide services such as assurance work, audit work, tax consulting, tax advisory, general advisory, specifically that takes up most of my time in addition to audit on blockchain-based digital assets, and also accounting and sustainability, which is the hot topic. So the approach that I want to take today is to give you an idea of the various transactions one can enter into in relation to blockchain-based digital assets. And first we're going to cover the basis by saying when the asset class emerged and when people started transacting with it, it was difficult because SARS merely said that the normal rules apply. So effectively they're saying the normal tax legislation applies to all blockchain-based digital assets. The only thing that they really did is they defined the word cryptocurrency and crypto asset in the Income Tax and the VAT Act. And so that's the bulk of the changes made. So we need to apply that existing laws and regulations to every type of transaction that you enter into when you're dealing with these blockchain-based digital assets. So in the middle there, we've got Emma. So Emma is a dev that works in South Africa, but she works for a foreign company. So for her remuneration, she effectively receives Bitcoin as part of a remuneration package. So every month she receives a Bitcoin, and we need to apply the Income Tax Act saying that it's taxable on the earlier of accrual receipt. So when that accrues to her in terms of a contract or where it's received into a self-custody wallet or her exchange wallet, that's effectively when the tax amount is triggered. So then Emma needs to go, she needs to look at the spot price of Bitcoin based on the USD spot price, convert that to South African rands using a rate. She can use the South African Reserve Bank, for example, and then effectively she calculates what her taxable income is from her remuneration. So what Emma then does on a weekly basis or a monthly basis, she does her grocery shopping at Pick n Pay, for example, and she uses an application for that similar to, or let's say she uses the Money Badger application for that and pays for her groceries in Bitcoin. Now, from the point where she received that remuneration up until the point that she's paying for her groceries, if there was a change in the Bitcoin price, effectively that would trigger another taxable event. So if there was an increase in the Bitcoin price, it's a taxable event, of course, including that gain in your taxable income as well. Then what Emma does in the third transaction, she actually uses some of her Bitcoin. She goes to one of the local exchanges. She exchanges some of her Bitcoin for fiat currency to pay the installments on her car or to pay rent or whatever the case may be. As soon as that Bitcoin is liquidated for fiat currency, South African rand, it triggers another taxable event. So effectively that also needs to be included in the taxable income based on the fact whether there's an increase or a decrease in the Bitcoin price from its original receipt in transaction number 1. What Emma then also does, she purchases some Ethereum, or rather Ether, with her Bitcoin as well, and of course this is where it gets tricky. That is also a taxable event, triggering, or rather a taxable event as a result is one asset class being switched for another. Now, what Emma then also needs to remember is when she purchases that Ether, she needs to allocate a base cost to that Ether as well, because for the next transaction she needs to determine what the gain or loss would be from that initial purchase of the Ether. Then what Emma does is, I'm very fortunate that Devin spoke before me because I talked probably just as fast as she does. But so when Emma then does as well, she takes some of that ETH and she enters into a staking solution where effectively she's going to generate yield. Now, that on-chain movement, if it remains Ether from a self-custody wallet or from an exchange wallet to let's say, a smart contract or whatever the case may be, it retains its form, so there's no taxable event from that point of view. So at least a little bit of good news for Emma there. And we'll get back to the staking rewards in a second. Now, what Emma then does as well, she engages on a decentralized exchange. She swaps some of the Ether that she purchased for some Uniswap. Once again, barter or asset-to-asset transaction, or we refer to that Income Tax Act as a barter transaction. So that executes another transaction. But Emma must go back to transaction number 3 and have a look at the price she paid for that Ether in South African Rand value to determine when she disposes of it or exchanges for it for Uniswap, what the various tax implications is going to be there as well. Then coming back to transaction number 6, of course, Emma also receives staking rewards. So for that staking reward she receives as well, that's also a taxable income or a taxable event that's being triggered there. And of course, lastly, the 7th transaction, what Emma effectively does is she moves some of her Bitcoin to a cold storage or some type of custody solution. Once again, an on-chain transaction, so no taxable event triggered from that, as long as it retains its form as Bitcoin and you're not swapping it for another cryptocurrency. The other element that I want to touch and I want to highlight here is some of the misconceptions as well with these various transactions that Emma entered into. So the first transaction we spoke about, a remuneration received by the foreign employer. So Bitcoin was developed to facilitate peer-to-peer payments over the internet without the need for an intermediary. And you can see I know this by heart and said it multiple times in my life already. But a lot of people think because it was designed to operate outside of the borders of the traditional financial services sector or the constraints of the traditional financial services sector, normal tax rules wouldn't apply. And of course, as we see today, that is clearly not the case. So in addition to that, a lot of people believe that because I'm receiving remuneration from a foreign source in South Africa, I wouldn't be taxed on it in South Africa because it's coming from a foreign source. You, as a South African individual, if you are a resident in South Africa and a tax resident in South Africa, you are taxed on a worldwide basis. So irrespective from where your income is being generated from, you are taxed in South Africa for that. Moving on to transaction number 2. When those micro gains and losses occurred that Emma is incurring, or let's say being exposed to by buying her groceries at Pick n Pay, there's a lot of people that believe that micro transactions can be omitted from the tax return as well, which is not the case. There are certain jurisdictions like Australia, like the US, that have this de minimis rule effectively saying that these micro gains and losses can be omitted from the tax return. Unfortunately, in South Africa, we don't have that. So you need to keep record of every micro gain or loss being entered when you make these types of purchases. The third misconception that I want to speak about is relating to transaction number 3, where Emma effectively, when she moved her Bitcoin to a local off-ramp or on-ramp or exchange, what do you want to call it, and she liquidated it for fiat currency. There's a lot of people that also believe, and I'm hoping there's not a hell of a lot of them, that transactions executed on the blockchain is private and it can't be viewed by anyone and it will only be there for a certain number of years. Any transaction executed on the blockchain is there forever. 100 years from now, the transaction will still be there. And of course, most blockchains are transparent, so you can view every single transaction executed on the blockchain. And of course, the exchanges do their KYC and their AML procedures so they know exactly who you are. So when regulators like the South African Reserve Bank or SARS comes to these exchanges, they usually dish up the information because they're regulated here in South Africa as well, and therefore they need to adhere to all of the laws and regulations applicable to them, in addition to sharing information with these lawmakers and regulatory authorities. So with transaction number 4, we spoke about that on-chain movement, where Emma effectively moved Ether on-chain from a self-custody solution to a staking platform as well. I heard a podcast a couple of weeks ago, or a month or 2 ago, where they said that constitutes a taxable event. That's not the case. When you move cryptocurrency on-chain, as long as it retains its nature, as long as it stays Bitcoin, you don't swap it for something else, it's not a taxable event, just moving the funds across. It's like making a transfer from a bank account, from your Investec bank account to your FNB bank account. Now, with transaction number 5, We spoke about Emma using the Ether to swap it for Uniswap. Of course, as I mentioned, that's a taxable event, but there was a lot of people, and I'm hoping once again there's less people out there that believe that crypto-to-crypto transactions isn't a taxable event. As I mentioned previously, in terms of the Income Tax Act, is deemed to be a barter transaction. Therefore, there will be gains or losses applicable when you swap one cryptocurrency for another. Now, back to transaction number 6 that you'll see on the screen is staking rewards. Now, I'm not too fond of the word staking because staking can be misinterpreted when you look at it from an income tax point of view, because staking can be you getting a yield and the same currency you basically invested, you're getting back, or you're getting liquidity tokens, or whatever the case may be. You need to look at the nature of the transaction to determine what the taxable event would be. But for the most part, staking rewards is included in your taxable income in all circumstances. There's very limited circumstances where you're actually able to apply that 23,800 rule or annual exclusion from an interest point of view. That's when you lend to someone in South Africa. So I lend to Leopold, for example, 1 Bitcoin, and he pays interest back to me in Bitcoin. It's from a South African source. Then can I apply that exclusion as well? Then the 7th transaction that I mentioned about is with Emma moving some of her funds to a cold storage or whatever for long-term investment. So there's a lot of people that believe that Section 9C of the income tax law applies, which effectively says when you hold a listed security for a period more than 3 years, it's deemed to be capital in nature. That's not the case because cryptocurrency isn't a listed security as defined in the Income Tax Act, so it doesn't apply to that. SARS will look at the nature of your transactions. They will look at it holistically as well. That's why when you do engage with those types of let's say, long-term savings or hodling or whatever you want to call it, there needs to be clear segregation so you can clearly demonstrate to SARS that this is for long-term gain. So other misconceptions, we spoke about that first bullet point. We spoke about the second bullet point. I think the third misconception on this slide that I want to mention as well is this misconception that SARS will only go back 5 years. So once they've got an idea that you evaded tax, they can only go back as far as 5 years. SARS can go back as far as they deem reasonable if they have reason to believe that you evaded tax. So they can go back 10, 20, 30, 40 years. It doesn't matter. In addition to that, SARS has this thing called a VDP, a voluntary disclosure program. So when you've come to a point and you said, well, shit, I've not declared any gains on my taxes for the past 10 years, you can enter to a contractual agreement with SARS called a VDP, and you can say, cards on the table, this is what I did. I know for a fact that I did it wrong, but I want to correct it now, and then you go through this VDP process. We've helped multiple people in the past with this. But if you wait till SARS starts the investigation, then you completely lose the ability to enter into this VDP. So you saw in the news recently, SARS is cracking up efforts as well to focus on this. Now, if SARS starts to question you and question a possible omission of a transaction, you completely lose the ability to enter into that VDP. Other considerations that I also want to make mention. You saw with the mentioning of transactions about the various tax events being triggered over and how complex it gets. And to make it even more complex, SARS prescribes that you use the first in, first out method to calculate what your gains is. Now, you can think from a record-keeping standpoint, it becomes an absolute nightmare. Fortunately, there are tools that you can utilize that plugs in with the APIs of the various exchanges and reads on-chain data to effectively recalculate what your taxable income is in a year of assessment. Don't wait till the last minute to try and do it and speak to your accountant. Most accountants don't know how blockchain-based digital assets work, and it takes a significant amount of time to reconcile these large volumes of transactions, which makes it extremely difficult. One last thing, and I think we've got 2 minutes left. Perfect.
Minus 2 minutes.
One last thing that I want to discuss as well. So there was a lot of focus on cryptocurrency and tax. And some of the things that people have, one of the main things that people have not looked at is exchange control regulations. So we've seen this pop up more and more, and I've been involved now with 2 legal disputes as well on this, where the South African Reserve Bank challenges these individuals that engage with blockchain-based digital assets that had contravened these exchange control regulations without them knowing it. So I think a lot of us sitting here also participate in arbitrage trading, and of course, Carl from Shiftly and I think Harry from Future Forex will also have a discussion later today. But effectively what you do is you use your single discretionary allowance and your foreign investment allowance to try and gain a profit from the arbitrage opportunities that is a result of the exchange control regulations. And you only have a limit of R1 million single discretionary allowance and R10 million foreign investment allowance in a year. So 11 million basically in total. So if you have utilized this and you go overseas for holiday with your family and you pay with your debit or credit card there, that's an immediate transgression of the exchange control regulations. When you buy goods and services and exchange them or in exchange pay on-chain with your Bitcoin, that's a contravention of exchange control regulations. It is still extremely gray and we're still waiting on clarity, but it seems like when you send to your Kraken wallet, for example as well, it could potentially be a contravention of exchange control regulations if you already used your 11 million rand as well. So we need to see how this plays out in South Africa, and it's going to be interesting to see how they apply these regulations in South Africa and force these crypto asset service providers in South Africa to have these certain limits in place to be able to say, well, stop them from externalizing these capital. So, and of course, self-custody is just as big a solution because the SAR will probably view that as an externalization event as well. But yeah, that's all we have time for today. But I am around for quite a while, so if you guys want to come and have a chat, please feel free, and we can chat about whatever. Cool, thanks.